Hello, everyone. Today on the final bar, we're going to talk market distribution, a day that started strong, all of a sudden feeling more leaning to the downside with things like technology, healthcare leading the way lower, a lot of bearish engulfing patterns out there, but plenty of stocks also going higher with financials really the big winner today. So we're going to try to pick through all those themes hitting the market from three different angles: top down, sector rotation, bottom up stock picking. We'll see what we can come up with. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the markets from a technical perspective, look at the charts together, try to make sense of the short-term movements, and most importantly, connect the short-term with the long-term, try to put things into proper context. So I mentioned in the introduction, the all eyes going into this week have been on S&P 3000. We talked on Friday's show about the importance of that key level. And all of a sudden this morning, we gap above 3,000. It feels like lights out, up and to the right, long and strong. And as this market continues to do, things just evolve, things change, things rotate. And all of a sudden, less optimistic than it might have seemed at the beginning when you look at how things netted out, even with the NASDAQ 100 finishing in the red today. So we'll get to all of that and more. I did want to highlight some of the guests we have coming up on this show and also elsewhere on StockCharts TV. Tomorrow, on Wednesday the 27th, my guest is Katie Stockton from Fairlead Strategies. On Thursday, Ryan Dietrich, who's the technical analyst at LPL Financial, a fantastic analyst. Next week, on Tuesday, we have Peter Brandt, who's prolific in social media, and a name and face that many of you probably are familiar with, fantastic trading expert. And then on June 3rd, Frank Capilleri from Instinet's going to be joining us. Also wanted to remind you on Monday, our next episode of Behind the Charts is featuring a conversation with Ralph Acampora. We went to his farm in Minnesota just before the Christmas holiday last December. Had a great special that we created, focusing on Ralph's 50 years on Wall Street, walking around that barn together. But in this episode, we actually talked a lot about just his particular process, his background. We dug deeper into a lot of that, and we captured that interview while we were together. It was really, really cool conversation. I think brings to light a lot about the benefits of data visualization and technical analysis. That's coming up on Monday on Behind the Charts. Let's get to our market recap. So I've often said leading up to this show, as we're getting ready to go live, my cup runneth over with things to talk about. And in a 30-minute show, there's so many places we can go. So what we're going to do on a normal Monday, but today on a Tuesday, because of the long holiday weekend, we're going to hit the market from three different directions: top down, sector rotation, bottom up stock selection, and just pick on some key themes that I found in my exercise going through these markets over the weekend, and share with you what I can. Again, I hope that this show serves not as the end of your analysis, but inspires you to kind of dig a little deeper on your own and uncover, explore some of these themes a little further. Looking at the charts, when we think about the market today, the big gap higher was significant. This pushed the S&P above 3,000, and so many of my guests, and myself included, have been on the bear market rally camp. As long as we remain below the 200-day, remain below 3,000, I think it's fair to see we could back and fill and go lower to the 2,800, 2,700 range, if not even further. The further we get, the closer we get to that 3,000 level, the less and less likely that feels. And all of a sudden today felt like it. But if you look, there are a lot of potential concerns underneath the hood. It just wasn't a clear-cut, long and strong breakout type of day. So here's the S&P chart, opened up around 3020 by the end, and a lot of this came in the last 30 minutes, back down to 2990. So finishing stronger than yesterday, but distribution during the day finishing below the open and getting us a little closer back to that 3,000 level. Worth noting, however, small caps, mid caps up big. So the S&P 600 small cap index up 4%, mid caps up 3.4%. So more the speculative, smaller, universe of the small cap index and mid cap indexes up fine, while the S&P sort of pulled back into the close. Worth noting, the NASDAQ 100 actually finished in the red. So while most things finished positive on the equity side, the NASDAQ 100 actually finished lower, and that's because of technology, which was sort of a drag on the market today. Tech finished flat for the day, but really was one of the worst performers. Healthcare was down a little bit more going into the close. Let's look at a chart of the S&P, and then we'll hit on some of the other themes. So this is the daily chart we've been looking at for quite a while. We talked about the rally from the March lows, sort of this pullback of sorts, which I've called a bull flag, which is sort of a big run higher, sort of a corrective move, parallel channel, lower highs, lower lows, and then we broke above there. And that was sort of the first indication, wow, this could really be building momentum higher. But that last line in the sand is S&P 3000. That's just above the 200-day moving average. That's the upper end of this resistance range that we've talked about previously. If you look, the S&P opened above the 200-day, traded a little bit higher, but by the close, we got back down below there. So you can't call this a breakout. You can't call this a breakthrough through that resistance level. At this point, it's confirming that resistance. Until you get a close above there, it's still holding. The RSI right at that key moment, right around 60, which again, in a bear market environment, that tends to be where the RSI will sort of peter out. So we're right at that point where we're either breaking to new highs or we're coming back and filling in some of this range. So I think, tomorrow and the rest of this week is going to be really, really key. We talked about today being really important after Friday holding above sort of that 29.35 level. And again, I don't think we got the confirmation you might have wanted today. Breaking down the market from a couple different angles, I think it's worth noting if you look at the advancers decliners. So this is the percent of New York Stock Exchange listings that were up or down on the day. This actually was a 90% update earlier in the day on that big gap higher. If you'd stopped the clock there, 90% of the S&P, of the New York Stock Exchange was actually closing higher than yesterday, which is a pretty key level. That tends to happen in bullish phases when there's plenty of accumulation to push the market higher there. But if you look by the close, it got down to around 80%, finished around 82%, which means, again, it's not a high momentum up day. It sort of pulled back a little bit, and that's as that initial sort of buying it out of the open sort of lightened up a little bit going into the closing hours. Let's look at some of the other markets, and we'll finish in with some of these different themes. Looking at bonds, it was certainly stocks over bonds today, even though, again, some weakness in stocks, but the TLT definitely lower, down 1.25% to 163 and change, pushed the 10-year yield a little bit higher. On the commodity side, most commodities up a little bit today, with gold and silver, sort of the precious metals, weaker. And the GLD finished down about 1.4% to finish above 160. So overall, that uptrend's still in place, but today certainly more of a move away from that traditional safe haven of gold. Looking at sectors, I sort of hit on technology and healthcare underperforming, but I think it's worth noting that financials, the big winner today, followed by industrial. So, we talked about things like the banks and others that have been, underperforming for days, weeks, months, et cetera. They've really been difficult places to be on a relative basis, up big today. And you saw that across asset managers, things like, Ben and T. Rowe and others, but also, Morgan Stanley, Goldman Sachs, all of these showed really nice breakouts or really nice accumulation today. So we're going to look at some of those charts when we get to the shifting stock segments in a little bit. In industrials, you have things like airlines up huge today, up over 10%. A lot of the major airlines in the U.S., things like Boeing up pretty big today. So, certainly a move back to the recovery trade. And things like REITs that have been beaten down, certainly getting a bid today. The leadership that has been leading, things like biotechs, others within healthcare and technology, certainly more on the weaker side. So it was sort of a rotation of sorts. And again, the question with this is, is this the rotation into some sort of new leadership, a recovery phase that's led by this next group of names, led by financials? I don't know if I could make that claim based on one day's trading, but I think those are the types of patterns I would be looking at a little bit going forward. We need to move on to our next segment, but again, there's so many macro charts we could look at. I wish we had more time to dig into some of those themes, but certainly plenty of rotation. Our next segment is called Sector Setups. And what we like to do on a Monday, beginning of the week, and here we're doing it on a Tuesday, is look at the 11 S&P sectors, focus on where they're moving, and think about it from a sector allocation point of view. What's working, what isn't, where are we seeing some changes? And what I tend to focus on is this weekly view of the RRG. And again, if you're not familiar with this methodology, my friend Julius de Kempener, who created this, I followed his work for many, many years and enjoyed being a colleague of his now at StockCharts. He does really good work explaining this on his show, Sector Spotlight. So check out some of those episodes on our YouTube channel. You can get a bit of a tutorial on how to use this. But the way that I think of it is it's visualizing the 11 sectors around the benchmark, which is right in the middle. And the general trend that we've been seeing as I sort of rewind a couple weeks is you've had this sense where technology, healthcare, consumer staples really being in a position of strength. You saw utilities and real estate, which are traditional defense, sort of rotating lower. You can see how UTs and real estate sort of now in that lagging quadrant, really demonstrating or confirming their underperformance. Technology has been sort of whipping around this area. It's never really gotten in the weakening quadrant. It's still relatively strong, but not really dramatically heading northeast as you would want to see in a position of strength. Healthcare, the XLV, you can see for a little while ago, maybe a month and a half ago, was just kind of sort of pointing long and strong, outperforming. You can see that's rotating lower here. So today's session with tech and healthcare on the lower part of the sector return list, just for today's trading, sort of confirms what we're seeing on the longer term charts as well. I think the real interesting movers here are consumer discretionary. You can see how this has just been moving northeast as a rewind about 6 weeks and rewind and fast forward. You can see how it's really been pushing forward along with communication services. Consumer discretionary, now this is driven in many ways by Amazon and Home Depot. The two of those are probably 30, 35, 40%. So I think that those two stocks are that much weight in the XOI. It's pretty significant. And so if you take those two names out of them, they're still doing okay, but not quite as dramatically outperforming. But you can see the long-term performance when you include the weights of Amazon and Home Depot actually doing very, very well on a relative basis. And you can see them heading northeast in a very healthy configuration. Materials as well, and a lot of that's been gold stocks, which have gotten hurt. They were down about 4 or 5%, if I remember right, today. So Newmont Mining has been one of our top stocks on the scooter rankings. It's down almost off the top 10 just because of pulling back while some of these other names have recovered a bit. But materials as a sector has been holding up okay. What I did want to point out, though, is finishing off energy. As much as I want to ignore it as a rounding error, sort of way off the side of the pin, not a rounding error, but more just visually, it's so far out of the game. It has continued to outperform, now in the improving quadrant for the first time, and I don't know how long, heading northeast, which is the direction of improvement. Overall, I think if you're not there yet, if you're not considering energy, it's certainly worth exploring and seeing what some of those opportunities might be, because the trends have certainly been in play, and there's been a lot of strong performance coming from the energy sector. Industrials, financials now rotating more to a northeasterly direction as well. So we've certainly had this rotation away from consumer staples, away from healthcare, away from UTs and real estate, into industrials, into financials, into consumer discretionary. And that rotation, and energy as well, that rotation, if that continues, certainly would be a change of sorts, especially if you would see technology rotating a little bit lower. That would be a very different environment than we've seen for quite a while. So I think that's a theme certainly worth paying attention to. Also the leadership in healthcare, which has been so steady with things like biotech and pharma, medical supplies doing pretty well. Starting to see some chinks in the armor there with some of the healthcare charts. Let's look at the 11 sectors using the candle glance page. So what I like to do is bring up the sectors here, sort of look at them. I wrote an article over the weekend for chart watchers, and I posted it on my own blog, The Mindful Investor, on StockCharts just today. And what we focused on was consumer discretionary. I mentioned that narrow leadership of Amazon and Home Depot. And again, if you take the two of them out of there, on an equal weighted basis, still outperforming, but not as dramatically. Amazon's strength has certainly contributed a great deal to this relative strength picture improving. Consumer discretionary is an interesting one, a big gap higher today. And so that, earlier today, it felt like, wow, we're going to 3,400, I think, on the S&P. Like, this is what would happen if that's sort of the case. But just like that, you start to get some questions. So we finished down toward the lows of the day. So the XLY gapping higher, but finishing weaker. So it's not sort of that feel good, everything falling through to the upside. It's more like there's some unfinished business needs to sort of continue. So I think tomorrow will be interesting to see what that next step is. If you look at the tech ETF here, the XLY, again, gapped higher, but then closed back within yesterday's trading range and the range of the last week and a half. So on its own, the trend's still positive. Don't get me wrong. Overall, still outperforming. That's good. But again, today's trading did not feel like a great upside follow-through day overall. Where it did actually feel somewhat impressive was looking at the financial sector, right? The XLF. And you can see, well, I talked about the rotation out of healthcare, out of technology. You can see the opposite move today where the XLF gapping higher, closing more toward the highs of the day in the upper half of the day. The XLF has a good amount of resistance up here. It's just above 2350. And so I think that's worth noting. If we're able to get a new swing high, that would be pretty significant. We're not there yet. So we're kind of up against some pretty significant resistance, which if you think about it, lines up pretty well with the S&P hitting its 200-day. And, you know, boy, you'd see the S&P recover back above there. You see the XLF break out, consumer discretionary continuing to improve. All of a sudden, it feels like we have some new leadership to push the S&P higher. But not quite there yet. Industrials also now breaking above a swing high, which is pretty impressive. You think a week and a half ago, making new swing lows, breaking below the previous support level, and the relative strength making a new 2-year plus low. Felt like that was just a dead sector, and the sector was going back to zero almost. And now we've completely turned over. The relative strength now improving, breaking above a trend line if you connect the last 6-7 weeks or so. Breaking higher, breaking above a swing high. So again, just looking at the 11 S&P charts, starting with the RG, but looking at these charts, you can see that there's a bit of a rotation here. And I think it's worth focusing on, especially strength in financials, strength in consumer discretionary, potential weakness in healthcare and technology. These are themes that would be a little different than what we've seen up until now. Also, I wanted to mention communication services, similar thing. A nice gap higher, looks a lot like tech, but finishing more toward the lows of the day. So that sort of follow through the rest of this week, especially as we're at month end leading to the end of May, could be some interesting themes as people rotate away from some of these growthy areas there where we've been in positions of strength. That's our sector setups for today. Again, so many movements I'm touching on as much as I can, but I hope this is the beginning of a process for you. I hope you can spend some time tonight, tomorrow, and further this week digging into some of these themes a little further, draw your own conclusions about what you're seeing. We're going to take a quick commercial break, be back with our next segment, Shifting Stocks. We'll see you in a minute.
The Chart Watchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the Chart Watchers newsletter.
Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. As a reminder, we love to keep this show interactive. Anytime you can send us questions, let us know what you're looking at, what questions you have about the markets, about charts, about technical analysis, about decision-making, behavioral finance, the StockCharts platform. Anything is fair game. We'd love to answer your questions on the air. Just send us an email, thefinalbar@StockCharts.com. We get a lot of great questions from our viewers. Also on Twitter, just tag us in a comment @FinalBarSCTV. We will gather all of those up. We've got some great questions from over the weekend, and we'll address some of those in our next mailbag segment, which will be tomorrow. We'll have another one probably on Friday. So keep your questions coming. We'd love to hear from you for sure. Our next segment's called Shifting Stocks, and as I've probably told you once a week, every weekend I go through the S&P 500 charts, usually on Sunday evening, as a way of just taking a step back. On Fridays for the show, I sort of get ready with a big picture review. I look at the macro charts, and then over the weekend, I like to focus a little more on individual stocks. And I'd remind you, if you're a macro-oriented investor, if you're trading the SPYs or the E-minis or just an asset allocator, I would remind you, even if you're not trading individual stocks, there is so much information to be gained by looking at individual stocks and how they're moving. And think about group rotation and where you're seeing strength, where you're seeing weakness, where you're seeing inflection points. Because understanding that rotation, a lot of times the broad market charts will reflect things a little bit later. You'll see things reflected on the individual names first. So it's certainly worth taking a look at. I have a total mishmash of charts because a bunch of things I was looking at over the weekend, and then today things just got pretty crazy with individual names. So I just started jotting down tickers. So we're going to whip around as many as we can in our time together before the end of the show. Within semiconductors, we've talked a lot of times about the importance of semis because they tend to be a good leadership group. So when semiconductors are outperforming, it tends to be a good market environment. They tend to do well in bull market phases. They tend to struggle in bear market phases. And if you look at NVIDIA, one of the larger ones, the relative strength overall has actually been pretty consistently positive. That's helped propel NVDA to be one of the top ranked scooter charts. It's in a top 5 right now. But if you look, it's actually showing a bit signs of a little short-term weakness. We had a bearish engulfing pattern today, and this is not the only place I've seen these. If you look across a bunch of charts today, I'll throw up a number of these, but you'll see them fairly widespread. And again, what that is an up day where the close is above the open. The next day we open higher but close lower, and the second day's open to close range engulfs the first day. So if you're looking at a candle chart, you see the two bodies. The second one is larger, and it engulfs the first day's bar. That's why it's called a bearish engulfing pattern, or a bar chart analyst would call this a bearish outside day. Same thing. It basically is showing you distribution in the short term. So NVIDIA was overbought. Now a bearish engulfing pattern kind of coming out of that region. It really suggests short-term weakness. So, you're getting short-term sell signals on leadership names like semiconductors, which tells me that the rest of this week might be a little more corrective than I would have expected, especially out of a gap higher today. PayPal is another place. So again, when I'm seeing some of these bearish engulfing patterns, I'm a little uncomfortable with that. In general, what you want to remember is with any sort of candle pattern, two things I would look at. Number one, a follow through. So tomorrow, do we get the follow through to the downside, breaking the low of today? That would sort of confirm that pullback. And again, it's suggesting short-term weakness for sure. The stop out of the sort of negative thesis, the bearish thesis, would be the high from today. So if we break above 155, close above there, that would suggest, note that bearish engulfing pattern was just a fluke. It's going higher, and that's sort of the exit to that short call, or that short-term bearish call. So again, we have a stock coming out of the overbought condition, coming out and a bearish engulfing pattern. So these high momentum names, all sort of showing a similar pattern. I don't mean to go through all of them, but Chipotle's and other ones. This has been a top 10 stock on our scooter rankings. Again, bearish engulfing pattern coming out of an overbought region. So there's certainly a pattern, pretty consistent, suggesting short-term weakness in some of those previous leadership names. Regeneron is an interesting one. You didn't get a bearish engulfing pattern. It actually broke below its lows. So Regeneron, if you look, has been in a strong performance trend for quite a while, right? The last 8 or 9 months have been pretty positive on a price basis. It's remained above its 50-day moving average pretty consistently. On a relative basis, a lot of the relative gains came in February and March as the market was selling off and Regeneron was actually going to new highs. But since then, it's continued an uptrend, but not, pretty much in line with the overall market. So the relative strength has tapered off quite a bit. We're now in the lower end of that relative range for the last 6 to 8 weeks. We've now broken through the lows from the last couple of weeks. Really have been a sideways trend for the last couple of weeks. Now breaking below that. So a break below the 50-day, a break below the swing low from April would be a significant change on the chart of Regeneron. Really hasn't broken a swing low since back in January. So it very, very much a different configuration than we would have seen from something like Regeneron. So worth noting some of those healthcare names that have come off a little bit. Worth noting, and I promise I'll get to some attractive charts here in a moment, but I'm seeing all of these leadership names rotating. So Newmont Mining down over 6% today. Gold miners, mining stocks, these have been groups that have been pretty consistently positive. And looking at the group returns here, gold miners as a group and mining stocks down 5 2/3%. So Newmont Mining leading the way down there. The relative strength, if you look, has been in an uptrend for the last couple months, and all of a sudden breaking down through a new swing low on a relative basis, testing the new the price low from the end of April. So again, with a lot of those names, you're looking back when you see that short-term pullback, looking at the most recent swing low to see if we break that. That would give us a new lower low, which would be a different pattern. Also, the 50-day moving average, this is kind of lining up pretty well. So on Newmont Mining, you have a pretty clear line at which you might expect some support, and if we break it, it tells you that we're getting away from some of those areas. In terms of things that actually have been holding up okay, we have just a minute left, so I'll try to get through some of these. Lululemon is within consumer discretionary. I mentioned the strength in the XLY. I've mentioned it's Amazon and Home Depot are huge weightings, but it's not just specific to those stocks. Lululemon on a relative basis is making new highs, making new price highs again today, and it closed down just a bit from the open, but still up over 1.5%. Again, the high from February was key. This is a stock that's already recovered that high. So if it's able to hold that, it's a pretty solid chart. And again, charts that are on a strong relative track like that, I think are worth paying attention to for sure. I did want to hit on some of the financial stocks, because a number of these, just like Regeneron and others, sort of showing short-term distribution. You have the banks and financial showing some short-term gains. So ETFC, E-Trade, gapping higher today, breaking above swing high, breaking above the 200-day moving average, up almost 9% today. That's an impressive rotation from a stock that's been sort of stagnant right at the 200-day. So certainly a positive breakout. And again, the trend appears positive there. And it's not just specific to that, but something like Morgan Stanley, this is like E-Trade, but a little further back. So you broke above the swing high, but you're testing the 200-day from below. But again, seeing all these financials potentially breaking above the 200-day moving average would be pretty significant. And again, if you look across the board, the whole sector up pretty well today. A lot of the banks still well below their 200-day. I would be focusing on those like E-Trade, which have actually already recovered them and holding up pretty well. Just to finish this segment, shifting stocks, I just wanted to point out with the airlines up big today, something like Southwest. What concerns me about these stocks, we talked about them last week, and I told you don't get too excited about it. Maybe I should have said get a little excited, because they're up over 10% today, which is, again, very impressive. But my concern was we still hadn't made a higher high. That appears to be changing. If you look at Southwest just as an example from the group, we've now broken above the swing high here from April. So stocks that I mentioned, like Newmont and others, sort of, are they able to hold those April lows? Here we have the opposite. Airlines have been so beaten down. You're seeing if they're able to recover their April peaks, and this one actually has. So the question is, it's broken above its 50-day, broken above here. Do we establish a higher low? And I think the next pullback on airlines is going to be really, really key to see if this is just a one-time thing or if this is a trend that's continuing to evolve. So boy, in 5 to 7 minutes, there are only so many individual stock charts we can look at. There are so many fascinating rotations that I'm seeing right now. I would encourage you to revisit some of the screens that you might be normally looking at, especially stocks making new swing highs and new swing lows, and see what sort of charts you can start to uncover. We need to wrap the show, folks, and go right to the 3 in 3 charts in 3 minutes. And here we go. We're going to start with this chart using breadth. We talked about this earlier in our market recap. And I'm seeing by the close, and again, we're still sort of going through all the data here, but about 82% of the New York Stock Exchange closing higher than yesterday. The reason why this is interesting is because earlier in the day, it was about 90% or really close to it. And when I looked at it first thing in the morning on the gap higher, I'm thinking, oh man, this is going to be a huge, this is the breakout. This is S&P over 3,000. This is it. But by the close, again, still impressive that 4 out of 5 stocks closed higher. But you can see how the S&P closing back below its 200-day. This was not the bullish breakout I think bulls would have hoped for. It was a nice up move, but I want to see confirmation. I've not seen it yet. Chart number 2, we looked at some of the charts like Regeneron, PayPal, Chipotle. These are high semiconductors like NVIDIA. These are stocks that have been leadership names. I classify them as in a momentum group, meaning they've had strong trends, have been continuing higher. If you look at the momentum factor ETF, MTUM, this tracks those stocks that have been on strong trends. You can see how the relative strength of this group has gone down in the last week. And this is today the big move down that you see in that ratio. So while not the end of the world, it's certainly suggesting, especially in the last week, a rotation away from some of those high-flying momentum names, healthcare, technology, and names that we've seen, and into things like financial, some of the beaten down, more value names that we've been writing off for so long. Just this may be the beginning of something different, but I want to see how those trends evolve. And then the last one is this, which is looking at the small versus large, the IWM on a relative basis, certainly breaking to a new swing high. And I'll be very curious to see if that trend continues. And folks, that's our show for today. I want to thank you for watching us every weekday after the close. All of our previous episodes on our YouTube channel, so check it out. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, Give us a like down below, leave us a comment, we'd love to hear from you, and most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.